Cursor hovering over buy market, 3 seconds. That's all it takes. A small green candlestick blooms on the 1-minute chart. Your heart rate jumps with the ticks, and your thumb inches forward like it has a mind of its own. You whisper, "I'll place the stop loss right after fill." The next candle wicks higher, snaps back, and your platform reveals what those 3 seconds really were. Adrenaline dressed as conviction. You hit the button, slippage. Now the chart prints a red engulfing bar, and your P&L flashes a warning you try to ignore. You move the stop just outside the noise. Price kisses it. You widen it again. Suddenly you're staring at the level you promised to wait for, except you entered 5 points too high and donated the difference to the spread. If this scene feels familiar, good. Today we're tearing out that 3-second entry habit, the one that wrecks your P&L on candlesticks, and replacing it with a process that keeps your brain calm, your stops honest, and your entries aligned with edge. Most traders lose money. Start here. Why do those 3 seconds feel irresistible? Because your trading brain isn't watching candlesticks, it's riding chemistry. A bright green burst triggers a dopamine prediction error. Unexpected reward incoming. Your amygdala flags urgency. Adrenaline lifts heart rate. Cortisol surges when the candle turns red. The body screams, "Do something!" Meanwhile, the prefrontal cortex, the part that weighs probability and risk or reward, runs on reduced bandwidth under stress. Mark Douglas warned about this in Trading in the Zone. When you crave certainty, you abandon probabilistic thinking and try to make the market validate you. Random outcomes suddenly feel personal. In The Disciplined Trader, he adds the deeper trap. Beliefs from structured environments don't work in unstructured markets. If you wait for certainty, the market punishes hesitation. If you act for certainty, you usually buy the spike. Past patterns don't guarantee next candle's path. Brett Steenbarger adds a performance lens. In fast conditions, attention collapses to self. Don't miss it, make back the loss, instead of auction. Volume, delta, and breadth fade while you negotiate with fear. Psychology 2.0 reframes this as process. Either you adapt mechanisms that keep you in data, or you default to urges that keep you in drama. Trading-specific biases pile on. Entry hesitation paralysis flips into FOMO impulse the instant a candle moves without you. Exit greed extension makes you pass planned scales because green P&L feels like proof you were right. Stop-loss removal syndrome whispers, "Give it air," and you drift into oversized drawdown. Revenge trading loops start with one chase and escalate into a flurry of clicks to reclaim identity, not edge. Over-trading compulsion rationalizes every micro-wiggle as a setup. Chart pattern hallucination turns 2 random bars into a breakout. Mirror neurons add fuel, see a posted wick fill, and you copy. Here's the paradox many intraday traders learn the hard way. The best trades rarely feel urgent. Continuations enter on a calm, higher low after the impulse. Reversals trigger when you're buying red into support or shorting green into resistance. The more analysis you stack in the heat of the moment, the worse your timing gets. Your brain hallucinates precision, and you click when liquidity vanishes. Tighter stops at obvious swing points rarely save you. They invite slippage and bigger losses. And there's a brutal truth. Most traders lose money. Not because they can't read charts, but because execution happens during chemistry, not process. Candlesticks become ink blots for whatever you need to feel. The 3-second habit isn't about the market's edge, it's about your brain's need for relief. Until you design your platform and routine to interrupt that loop, every green candle is a slot machine spin, and the house is your P&L. You watch a level on TradingView, prior day high, VWAP, and the 20 EMA stack into resistance. Price consolidates beneath it. You plan. If we reclaim and hold above with rising delta and volume, I'll enter with a stop loss 2 ticks below the base. Then the 1-minute candle spikes over the level. Your plan says wait for hold, but your thumb says now, so you hit market. You fill at the wick. Level 2 shows offers pulling. The footprint prints stacked buy imbalances above, then vanishes as sellers step in. The candle closes back under the level. You rationalize. It's just noise. You widen the stop and try again. 2 minutes later, a true reclaim occurs. Impulse, pause. Higher low, but you're too anchored to your bad fill to add properly. When it finally runs, you bail break even because you don't want a loser. and then watch price push to your original target without you. This pattern burns capital 3 ways. First, adverse selection. You buy when liquidity is thin and get the worst price. Second, slippage and spread. Market orders at extremes pay the tax of urgency. Third, psychological drag. The early pain flips you into loss-averse management. You cut winners too fast and let losers breathe. Every candlestick sequence looks the same from 10,000 feet, but your entries decide whether the same idea has positive expectancy. Entering at the wick turns a 2.1 risk, or reward into 1.1 or worse, even if direction is right. Moving the stop away compounds it. Tighter stops at obvious highs and lows invite stop hunters. Wider stops without structure invite oversized drawdowns. Then revenge trading loops in. Hard. Enter Marcus the Scalp Master. 3 monitors. On the left, order flow level 2, time and sales, footprint in delta, volume profile. Center, the active instrument with 1 and 5 minute candlesticks plus a 15-minute anchor. Right, the workspace journal, alerts panel, risk dashboard. He trades liquid futures and large caps at the open, often 50 micro trades. His motto, each trade is one breath. But Marcus wasn't born disciplined. He used to click the burst by the third green, fill at the wick, move the stop, gift the spread. He blew a small account, then another. Reading market wizards, he noticed an uncomfortable constant. The best performers talk more about risk than predictions. Douglas's work gave him what he needed, probability thinking. The way to trade gave him mechanics, predefine rules, then execute mechanically under pressure. Watch him during a drawdown. A red streak triggers a cortisol wave. He feels heat in his neck, his body's tilt signal. He leans back, inhales for 4, holds for 4, exhales for 6 to reset state. His preset rule is binary. If 2 consecutive execution errors occur, late entry or missed stop, he steps down to simulator for 10 minutes or reduces size to 1/3. No debate. The platform enforces it. A risk plugin hard limits daily loss and blocks new orders. His morning routine runs like a pilot's checklist. Before the bell, he tags 2 primary setups and 1 alternate per symbol, with trigger, invalidation, stop loss, add-on rules, and take profits. He places alerts 5 to 10 ticks before the trigger, so the platform, not his amygdala, tells him when to look. He rehearses if-then scenarios. If we sweep pre-market low and fail to find sellers on the footprint, then I enter limit at the reclaim with stop 1 ATR below. On the open, Marcus lets the first impulse print. He refuses to hit market extremes. He waits for the tell he trained himself to see. Impulse, pause, higher low with absorption, then continuation. Only then does he place a limit with an OCO bracket mapped to structure. If stopped, he takes the loss without moving the stop a single tick. Risk management is survival. Now the rewiring. Marcus broke the 3-second entry habit with 5 trading-specific moves. First, delayed trigger entries. He banned market orders at extremes. For breakouts, he requires 2 stages, an impulse above the level, plus 1 of 3 signals volume expansion through the node, delta continuation with stacked bid depletion, or a 1-minute close and immediate higher-low hold. He enters on the higher low with a limit at the pullback price, never at the spike. Second, stop first execution. His hotkey sequence is stop, entry, target. A bracket OCO places the stop on ATR or structural distance first. Only then does he click the entry. The platform won't accept the order unless the stop is defined. Risk management is survival. Third, the 3-breath rule. When an alert fires, he takes 3. Complete breaths while scanning level 2, footprint, and the 5-minute context. During those breaths, he asks 3 questions. Where am I wrong? Who's trapped? What's my risk or reward? If he can't answer, no trade. Fourth, statistical desensitization. He ran 2 weeks of replay, taking 200 simulated entries only on pullback after impulse. He tracked slippage, MFE or MAE, and time in trade. The data taught his nervous system what patience feels like. Better fills, shorter heat, steadier P&L. Deliberate practice over drama. Fifth, session caps and cool-offs. A 3-strike rule, 3 consecutive losses, or 3 execution rule breaks, and he's flat with a 20-minute walk. no screens, no phone. When he returns, he reduces screens to instruments and plan. More screens mean less clarity. He engineered the environment to quiet the urge. Concrete example: consolidation under resistance. Price presses the level, buys lift offers, but the profile shows a high volume node just above. His alert fires 5 ticks early. He breathes. A micro break prints. Offers reload. Delta stalls a likely stop run. His rule says no chase. Minutes later, a higher low holds above the level with continued absorption. He places a limit at the pullback, gets the fill, stop 180R below structure, scales at prior high, and trails under successive higher lows. This sequence rewards discomfort over urgency and retrains dopamine. The hit comes from executing rules, not chasing candles. Past patterns don't guarantee future results. Rules can guarantee behavior. Here's the picture when the habit is gone. Volatility arrives and you stay still. Candlesticks can sprint. Your hands don't. Alerts pull you to prepared levels. Breath slows the click. The first order on the tape is your stop, not your impulse. You accept missed moves for selectivity. You place the stop loss where the trade is wrong and never move it away from risk. You let winners work to planned scales because you're not trying to be right. You're trying to express an edge repeatedly. Your P&L smooths not because every day is green. Most traders lose money and you will have red days, but because tail losses shrink and wins grow. Bad days end small because cool-offs trigger. Good days expand because ads are rule-based entries. You think probabilistically, one trade, one breath. You respect drawdown limits and margin. You treat RSI divergence and volume profile as context, not commands. And when the market runs without you, you smile, no chase, and wait for the next higher low. Not financial advice. Past performance isn't a promise. Risk management is survival.